Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment at the market site in Times Square, we have Phil Mackintosh, chief economist at Nasdaq, and we're going to take a look at the multiple global factors that are putting stocks under pressure through the end of September and, of course, the beginning of October. And Phil, it largely seems that it continues to come back to rates, inflation, and, of course, shortages.
Yeah, I mean, that's one of the factors right now. The other factor that's going on is obviously all the government spending, government debt ceiling related issues. So whether the stimulus will be 3.5 trillion or less, whether we're going to have a debt default and how that's going to deal, whether the government can approve the debt ceiling increase. And also China, which we talked about recently, is still there and its economy is still shrinking and it's still got the Evergrande debt problems. So there's a few headwinds out there in the market right now.
There certainly is, and when we talk about energy prices and their multi-year highs at this point, not even just oil, but natural gas, that certainly lends to the inflation is transitory argument, and no, it's not.
It's not looking like it's going to help, is it? Because the whole transitory inflation issue was, well, we've got cars that the prices have gone up, but that's because of the chip shortage, and we've got wages going up, but that's because wages went down, and we've got airline tickets going up, but that's because they were down. Oil's completely new, and it's likely to filter through to inflation in a more permanent way, I think, in terms of its impact on inflation as well. So we are looking at some, to your point, supply chain stresses that are forcing energy prices up, forcing input prices up, really adding to the inflation across the economy more.
And what are we seeing closer to home?
Yeah, so basically the same sorts of things. We're seeing a lot of supply chain shortages. We're seeing producer price rises, so the input costs for producers are going up, and we're also seeing the delivery times are still going up as well. So lots of inventory shortages, lots of stresses on the system, shortages of labor, wages rising, like lots of inflationary pressures.
Right, but let's talk about that when it comes to labor. We know there's jobs openings. We know that there's rising wages. It seems like it's a great time to be someone if you're looking for employment, but it doesn't seem to be that we're getting the labor market back to normal.
Yeah, it's weird, isn't it? I mean, if you look at the unemployment rate, it looks really good. It looks like we've basically fixed the economy. But if you think about the number of people that were employed and now are employed, we've actually got a huge gap. And part of that is people that have retired. But the rest of it, we're not really sure. Why is there still such a big gap and so few workers coming in, even though there's a lot of jobs that are open right now? And so one of the concerns is COVID, but there was a survey out recently that showed not much of the people that aren't coming back to work aren't coming back because of COVID. One of the other factors is looking after kids, but now we're all got kids back to school. You'd think that that might have fixed itself. Hasn't really been the case. And obviously all of the pandemic benefits have now expired as well. So you'd expect the workforce to start to increase again, and it's just not.
Yeah, it makes you wonder if it's just a generation of burnout, really. I mean, especially, with the way that we look at work here in the States. Anyway, Phil, great to see you as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.